All right. You feeling ready?
I'm ready.
Perfect. Welcome back to the Roadmap to Retirement podcast. Jennifer, thank you for being here.
This is Roadmap to Retirement. Tune in for financial tips, investment strategies, and smart money moves to supercharge your retirement savings. Alex Neri, CFP, and guests are here to help you build your roadmap to retirement.
Jump right in. Tell the people what you do.
I'm a CPA. I do taxes, accounting, tax planning, just all the exciting things.
Awesome. Accountants are always so excited about their work. It's funny like that. So thank you for being here. I thought what we might cover today is you and I were having a conversation that kind of happened organically. We were talking about how you find a lot of people have questions around Roth conversions, which is a topic that I spend a lot of time talking about.
Right.
So I thought I'd bring you on and we could cover Roth conversions once and for all and hopefully answer a lot of people's questions. So start us off. What are the most common questions that you typically find people ask about Roth conversions?
A lot of time, just as a baseline, it's I read this online or I heard about this from somebody else. Why would I do this?
Okay.
So it's really just a baseline of you're trying to minimize your taxes throughout retirement and maximize your wealth. So that's really the kind of the introductory question I get a lot.
So I should probably start with what is a Roth conversion? So a Roth conversion is taking money from a pre-tax IRA, converting part or all of it, but usually part of it over to a Roth IRA. When you do that, you are making that income taxable in the year in which you do the conversion. So you're raising your taxable income for potentially 2025 with the hopes of being able to take money out of your Roth IRA tax-free down the road. And if you're in a lower tax bracket or a higher tax bracket in the future, those are the things you need to consider when making that decision.
Yeah, a lot of the planning is around, there's a significant segment of the population, our generation, that has a lot of money in pre-tax retirement. And the required minimum distributions are really going to be an issue in pushing them into tax brackets that they didn't plan on being in.
Yeah, I think that's what we find a lot of times is a lot of the clients we work with are right around retirement age. So let's say they're 60 years old. They retired from working at a large corporation that had a 401k all those years. They started off way in the beginning of their career saving into their 401k. They did a good job saving, which is awesome. They have money, they can retire, but all of their money is in this pre-tax account. So if they've got $2 million in their 401k or their IRA, and they know every time they take a penny out of that, they have to pay tax on it, it creates kind of this tax balloon that they don't know what to do with. And that's usually when we back into the, hey, have you considered a Roth conversion? Here's why it might make sense. I trust that's probably where a lot of the conversations you're having are starting.
Yes. Yep. Exactly.
Okay. So we'll get into some of the changes to the IRS tax code, but what are some other considerations to the Roth conversion in your mind that maybe people don't think of other than just the tax bracket they're in?
So there's a few factors. There is the fact that your IRA balance at retirement is going to be a lot higher as you start taking RMD. There should be. The market continues to grow. So a lot of people think I'm paying the tax now or paying the tax later, which isn't necessarily true because you're pushing some money into some tax-free growth and eliminating the tax on that later. So there's that. There's also a Medicare Parts B and D, I believe, are income-based. You want to really calculate the Roth conversion on the comfort level of paying surcharges that may come into place if your income's over certain thresholds. And then just the taxability of Social Security. So some people, especially in the initial years of retirement, are living off savings. They're not drawing from RMDs yet, but they're taking Social Security. Much of that is tax-free because their other income is limited. Whereas once you start converting and once you have to start taking the RMDs, up to 85% of your Social Security can be taxable. So those conversions may sound like I just want to pay in the 12% bracket, but when you add an extra income and now they're paying tax on the Social Security they already received, plus the conversion amounts, sometimes it gets a little shocking.
No, we call it the Social Security tax torpedo. I don't know if that's a term that's gone into the accounting world, but in the financial planning world, that's the term they've coined. So there's two issues you brought up. One has to do with Social Security. The other has to do with Medicare. So address those a little bit more in depth. So with Medicare, a lot of people don't understand this until they get to age 65. When you turn 65, the premium that you pay for your Medicare is going to be based partially on your income. So it's the income-related monthly adjusted amount, or IRMA table. The base premium for 2025 is $185 a month. And then you add on to that if you have additional income. So a lot of people don't realize that. And it's a 2-year look back also, which we should note. So even if you're 63 now and you're listening to this and you're thinking, I have 2 years before I have to care, That's wrong. You have to care now because the premium that you pay at age 65 is going to be based on 63. So we have a lot of people that they'll do a Roth conversion up to a threshold of the IRMA table. They'll use that as a tax bracket, if you will, to say, I want to go up to this payment, or they stick with the federal tax brackets with that. So that's one. And then Social Security was the other point. So back to the tax torpedo. What do you do with that?
There's not really a way to avoid it. The goal is to have your overall tax reduced in retirement or when you reach RMD age. So if you're paying tax on some Social Security now, but you're converting tens of thousands of dollars into tax-free funds that will then grow, it's usually worth it.
Right. Yeah, we find, you have to have very little income to not pay any tax. It's under about $40,000, I think, is the line for a married couple. So back when they rolled out these new taxes, the history of Social Security. So it used to be that Social Security was a benefit that you received tax-free until I think like 1983 or 4, and don't quote me on that, sometime in the 1980s. And then our politicians said, hey, we need more tax revenue. So we started taxing up to 50% of the Social Security benefit. And then in the 90s, a decade later, we needed more tax revenue. So the current law is up to 85% of your Social Security income can be included in your taxable, or included as taxable income. But they set a line in the sand of about $40,000. So people that were making below $40,000 weren't affected by this. People above that number would have to now pay attention to this new tax. And they made it in a way where they didn't adjust for inflation. So I think in like the 1980s, when they rolled this out, if you had $40,000 in retirement, you were like killing it.
Right.
You were rich. They always introduce these new taxes as only affecting the rich people, but this one, they didn't adjust for inflation. Though now, long story short, we find that most retirees have $40,000 of income from somewhere, whether it's a pension or part-time work, or they're taking distributions to their IRA to live on. It's hard to live on less than $40,000. So most people are affected anyway, but I guess you're seeing people with Roth conversions that still need to be mindful of that.
Yeah, there are people that retired earlier than the typical 59 and a half and they're planning on living on savings for quite some time, which wouldn't be a Social Security age. People that retire at 62 that don't really need to take IRA distributions. They're not RMD age. Okay. They just want to live off savings for a while.
Sure.
So their income's very low.
Okay. Yeah, I think those people are setting themselves up for, there's a doomsday scenario. So I talked about my hypothetical example earlier was you retire at 60, you've got $2 million saved in your 401k. And that's like a lot of people we run into is they've saved in a 401k forever. That's what they have. And it's a good spot to be in the sense that they have money saved, but it's all pre-tax. And then a lot of times those people also have a pension or the part-time job, or there's something going on where they don't need that money to live on. So the money is staying invested in the 401k. And then if they're 60 years old today and their RMD age is until 75, we're probably going to double that money twice in that time, just with typical market performance and compliance disclaimer. That's not guaranteed, but hypothetically, that's what we've seen. So if we've got $2 million today, doubles once we got $4 million, doubles the second time, I've got $8 million. And now I'm 75 years old. I've got $8 million in a pre-tax account. And I have to take an RMD out, which is going to be 3 to 4%. So do the math on that. That's a pretty sizable forced distribution that, mind you don't need. So taking money and paying tax on, we don't need it. So painting the doomsday scenario, that's what we're trying to avoid. So if that person can start to convert little chunks over that 15-year period, maybe we get to a situation where instead of having $8 million all pre-tax, we have $5 or $6 million pre-tax, which is still a pretty big number. But we've got the other $2 million in a Roth account where they don't have to take RMDs. Then even if they did, they wouldn't be paying tax on it. The consideration. It's a long story.
Yeah.
I'm doing all the talking. Do you have anything to add to that?
No, I think that if they're in that situation and they can live for the next few years without having to pay much tax, that's great. But once those RMDs hit, their tax bracket's going to be much higher. So their Social Security is going to be taxed at a higher rate. And it's going to it could still affect Medicare. So you have to look at the whole picture, the long road.
Absolutely. I think it all boils down to being a little uncomfortable today.
Right.
So you don't have this major pain later. Another consideration we talk to a lot about with clients is you get to a point in retirement where maybe we have this realization that we're not going to spend all $2 million we have saved. When you start out saving for retirement, you're not thinking about your kids or beneficiaries. You're just trying to save money so that you can retire someday. And then a lot of people just find themselves in a fortunate position where they've oversaved. They've saved enough money and a surplus of money they'll never spend in their own lifetime. So we start to talk about estate planning. We start to talk about transition to the next generation. And it gets back to a Roth conversion conversation because let's say I've got $2 million and my son or daughter is a surgeon making $400,000 and they're going to inherit my money versus I've got the same $2 million and my son or daughter is I think I'm the starving artist. They're a starving artist and a career has never been lucrative for them. So when they inherit the money, it's going to be a very different situation. So I think my message to retirees a lot of times is let's be mindful of who's going to inherit that money. And it might be better for you to pay taxes today, even in the 22 or 24% bracket, than your surgeon child inheriting the money and paying tax at 37%. Or maybe it doesn't make sense to do a Roth conversion because your son or daughter's going to inherit the money and pay 12%. So let's let them inherit and pay taxes. But
Yeah, especially in light of the more recent inheritance rules where those people only have 10 years to distribute that account. Millions of dollars on top of a surgeon's salary is going to be.
yeah, and the reality too is like when do people typically inherit money? It's probably in their own prime earning years. So your son or daughter is going to be in their 40s, 50s, early 60s when they lose their parent. And they're probably earning more money than the 20-year-old did, of course. But
Right.
so now they're inheriting this money. They have, to your point, this 10-year spend down rule where they have 10 years to spend the inherited IRA. And you take your $2 million, you divide it by 10 years, and really easy math. We've got $200,000 tacked onto our already $400,000 surgeon income. And now we're paying 37% tax on all of it, which is,
Right. On federal and then probably state.
it turns out New York State charges tax too. Who knows? Yeah, that's a good point. We had always got to consider New York State taxes on top of that as
Yeah.
well. And of course, all this is subject to change. Who knows what the next IRS tax code looks like whenever that happens.
But theoretically or historically, taxes have never gone down. We're at a good spot in the last 8 years and possibly the next 3 with the temporary provisions. But anytime I look at the tax rates with clients of Roth conversions, it's clear that taxes are only going up.
Yeah, I think that makes sense if you think about, not to get political at all, but like where we are as a country, like we spend a lot of money, we have a big
Mhm.
deficit. At some point, we've been saying this for decades now, but at some point, someone's going to have to pay for this. So maybe tax rates will go up in the future. One little add-on point to the point about who's inheriting the money is I've seen people who they go down this road of Roth conversions and then come to find out that their goal is to leave money to a charity, which is a giant mistake. So if you don't know it, if your charity or if you leave your IRA to a charity, they're not paying tax on it. So to do Roth conversions, pay tax on it now,
Right.
and then leave it to a charity that's not going to pay taxes anyway doesn't make a lot of sense. So if, again, someone's listening to this and you're charitably inclined, consider leaving money from your IRA to a charity and maybe other money that'll go to your children, and it's a better tax situation for everybody.
Yeah, that's definitely one of the considerations. When I talk to a client about Roth conversions and they're charitably inclined, we typically bring in a financial advisor and look at qualified charitable distributions from the IRA or donor advised funds and see if there's not a more tax efficient way to get the money into the charity's hands or just a mix of Roth conversions and those items.
Sure. But this wasn't the point of today's podcast, but you just brought up my favorite thing in the world, which is the QCD. Do you want to talk QCD for a minute? Sure. All right. Do you want to tell the people what a QCD is?
A qualified charitable distribution is a distribution from your pre-tax IRA directly to a qualified charitable organization, and you may exclude it from income because it's not. So a lot of people think I'll get an itemized deduction because it's charitable, but this is an even better case because you don't have to itemize. So a lot of people are not itemizing now, but that money goes directly to the charity. You're not taxed on the income, and then the charity has the funds to use.
Perfect. Love it. This is like the solution for, I run into people all the time who say they like to support a charity, but they're bummed out because standard deduction is 30 some odd thousand and they
Right.
can't take advantage of that anymore. So insert the QCD and here we go. The only kind of drawback is the podcast. So I don't know how many people over the age of 70 are listening, but you do need to be 70 and a half to qualify for it. So you
It is.
catch you to that age. So all our younger listeners, file this away in your brain. Someday you can do a QCD, but I think it's a great solution for even just the normal retired couple that gives $500 to their church at Christmas. Like you can start to use these things to
Yeah.
make a marginal difference on paying a little bit less tax, which is
Right.
something everybody wants to do. So
Yeah. The new tax bill, however, does make $1,000 per person above the line. So you don't have to itemize for charitable
that's right.
deduction. So
That's
that's
nice.
kind of a bonus, $2,000 for a married couple.
Yeah, that's good to know. So it's $1,000 for an individual, $2,000 for a married couple, and they can take a deduction that's above the line. So it,
So they don't need to itemize to do
yeah,
that. So that should help charities too.
great. You brought up the big beautiful bill. So let's talk about that for a minute. I know that it's new, so I don't think either of us feel like we're totally versed on every single detail of it. But what are some big takeaways that you think maybe retirees should focus on?
Yeah, especially related to Roth conversions. There was all this talk on the campaign trail of no tax on Social Security. That is not the case, but anyone
Surprise, that didn't
65,
happen.
no,
Okay.
but anyone 65 or over can get another above the line deduction. So in addition to either their standard or itemized deductions of $6,000 for single, $12,000 for married, but you do have to be in an income. So that starts to phase out at 75,000 adjusted gross income for single people and 150,000 for married, and it goes away at 250,000 basically. So it starts to phase out at 150, goes away at 2.
Okay. And to be clear, and I know you already said this, but I think a lot of people are confused on this. That is above the line. So it means it could apply to somebody taking the standard deduction. It could also apply to somebody that is itemizing, which is important because it's not just an increase to the standard deduction. It is something that people that are itemizing can take advantage of. Now, it's probably rare to find somebody that's under that income threshold of 75,000 that is also itemizing, but they're out there, right?
Yeah, I mean there's property taxes and things that drive it up, multiple
Absolutely.
homes.
Sure.
Yeah.
Homes, yeah. Okay. So that's a good one. The other ones, a lot of the big, beautiful bill tax changes, seems like they don't really affect retirees. There's one about not taxing tips,
Right,
overtime
overtime.
changing a little bit, but I'm picturing a typical retired person or couple probably isn't affected by that. Are there other ones that we should be thinking about?
Possibly the SALT, so the state and local tax deduction. A lot of people did not itemize because state and local taxes have been reduced to 10,000 per year since 2018. That now is up to 40,000 as long as your adjusted gross is under 500,000. So it's possible that might put more people into itemizing deductions, but a lot of retirees have paid off their mortgages. They're doing QCDs instead of outright charitable contributions. So it's really something to consider, but may not impact
Okay.
a lot of people.
All right. So we have three main things for retirees to focus on. So we have the charitable contribution that they can now take $1,000 for an individual or $2,000 for a couple. We've got the $6,000 deduction that's phased out at 75 or 150,000.
Right.
We've got the SALT tax, which the SALT one to me seems like it's always going to continue to evolve. Is that just the number one thing on every politician's mind is how can I change the SALT tax?
I think in states with high property taxes, high income tax rates. So in New York, it's certainly always going to be a thing.
It's topic for New Yorkers. All right.
Yeah. New York, New Jersey, California, those states.
Okay.
Some other states with lower property taxes, they might not have even reached 10,000 a year. So it's not as big of a deal.
Cool. All right. So we're getting towards the end of our time. We've covered Roth conversions. We talked about the new tax stuff. We snuck in a conversation about QCDs, which is always exciting to me. The one other thing I thought we might talk about today is the step up in basis rule and how you might start to think about your assets differently as you get towards maybe the later end of retirement even. So to fill people in on this, so step up in basis means that if you inherit a investment, so a stock, bond, mutual fund, whatever it is, you are going to inherit that with a stepped up basis, meaning the cost basis on the investment is now the fair market value at the date of death, not what that person originally bought it for. So if I bought a stock for $100 and my child inherits it and now it's worth $1,000, they're going to wipe out that $100 basis and the basis is now going to be $1,000. So this is a huge advantage for people inheriting money.
Right.
And I think it goes back to the conversation we had before about similarly how we might decide to do a Roth conversion or not do a Roth conversion based on the tax situation of our children. We might also spend money in retirement differently based on whether or not there's a large basis to be stepped up or whether or not we're talking about a pre-tax account. I guess I don't know what I'm asking you other than do you have any insights on like a strategy around how you approach that or?
So I don't so much have a strategy on how to approach it, but
Okay.
I've seen a lot of people make the mistake of
Okay, perfect. Let's do that.
putting their child on the deed
Okay.
for a dollar exchange or something like that. So then when that child inherits the house, they're already an owner, do not get the stepped up basis,
Right.
which costs a lot of money. And even on a personal residence, if that's your only asset that you're passing on, to not have to pay any tax versus paying tax on with no cost basis is a huge difference.
Right.
So there's that possibility. And also, there's a lot of social media posts that they take your beneficiaries off everything and put everything in a trust. And you really have to go to someone in your state because
Yes.
every state is different, and talk with an attorney and figure out the best way in conjunction with your financial advisor, your CPA. It's a team effort, but do not believe
Don't take financial
either.
advice from TikTok.
No
Is that-
TikTok
okay, got it.
advice. A, and B, if your friends put their kids' names on the deed, that's not solving the end problem. It might solve something short term in terms of Medicaid planning or something like that, but I would imagine that people listening to your podcasts are probably never going to be eligible for Medicaid.
Maybe. The thing we see a lot with, to your point about the step up in basis, is retired couple getting older. They've got a vacation home somewhere and they're worried about the nursing home. If you're listening, air
Right.
quotes, the nursing home stealing their vacation home. So they say, I'm going to put it in my son or daughter's name. So they do, which if there's a 5-year look back, and we can get into whether or not that makes sense. But the problem with this too is now this couple passes away. And rather than the son or daughter inheriting the vacation home, they now have that original cost basis. So if you bought the
Right.
vacation home in 1975 and you bought it for $30,000, now it's worth $2 million, and your son or daughter goes to sell it, they now have to pay tax on all those gains, which is
Right.
probably not great. Now, if the conversation's been had and your son or daughter wants to keep this house indefinitely and they're never going to sell it, then maybe it doesn't matter. But I think a lot of times the next generation is not as interested in maintaining a second house as their parents have been, and all of a sudden they
Sure.
want to sell it, or they think they want it and 5 years of stress goes into it and then they don't
Yeah.
want it anymore. So I think people just need to be aware of that.
Yeah. Yep, I agree. And there's so many options available to do Medicaid planning, to avoid the tax on the beneficiaries. Really just considering to pay for advisement now rather than have them pay the tax later.
Yes, absolutely. Talk to a professional.
Yeah.
We're biased, but talk to a professional. Very good. Thank you for coming on. Before we cut it off, is there anything else that you want to cover?
I don't know. I think we've covered Roth conversions pretty intensely.
Pretty intensely, intense Roth
without
conversions.
putting numbers to it. But yeah, I think some good information.
All right. Thank you for doing this, and we'll talk soon.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA and SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Individual tax or legal matters should be discussed with your tax or legal professional. Jennifer Stott is not affiliated with or endorsed by LPL Financial or Cultivate Financial Planning.